Homegrown Bitcoin ETF provides investors with a regulated pathway into the cryptocurrency market.
When you're ready to take your investments to the next level, you might want to consider Monaco.
Hello and welcome to the Global View on this Wednesday. I'm Andrew Gagan. Good to have you with us here at ausbiz. Let's take a look at how we finished up overnight. European shares lower as the relief rally in French shares faded. Well, investors were focused on comments from Fed Chair Jerome Powell. He said that the Fed needed to see more data before changing policy. Wall Street's main stock indices closed higher, boosted by mega cap growth stocks as Treasury yields slipped across the board. The S&P 500 closing above 5,500 for the first time. Tesla surged to its highest level since January after the EV maker reported a smaller than expected 5% drop in vehicle deliveries in the second quarter, with price cuts failing to lift demand for its Chinese rivals as they increase sales. Shares of EV startup Rivian rose after reporting vehicle deliveries rose around 9% from a year earlier. US-listed shares of Novo Nordisk fell after President Biden called for the Danish drug maker to cut prices of its Ozempic and Wegovy drugs. Rivals Eli Lilly and Pfizer also falling. Paramount Global shares rose strongly on news that the billionaire Barry Diller's digital media conglomerate IAC is exploring a bid to take control of the media giant. Well, the US Federal Reserve still needs more data before cutting interest rates, says Chair Jerome Powell, to ensure inflation readings give a true picture of underlying price pressures. He said, "We want to be more confident, frankly, because the US economy is strong. We have the ability to take our time." Yet, Chicago Fed President Austin Goolsbee said he feels there are warning signs that the economy is weakening, saying we are on a path to 2%. If you just hold the rates where they are while inflation comes down, you're tightening. So you should do that by decision, not by default. Well, the latest data shows US job openings increased in May, reversing the downward trend of the previous 2 months, but layoffs picked up amid slowing economic activity. The measure of labour demand rising to 8.14 million at the end of May. US Treasury yields dipped following Jerome Powell's comments, with the 10-year down to 4.44 and the 2-year at 4.74%. And the US dollar also weakened. The Aussie has risen to 66.7 US cents in the wake of the Reserve Bank board minutes, which showed discussion about whether policy was tight enough to ensure inflation would slow as desired. Time now to get a view on the US market with equities. Dave Sekera is the chief US market strategist at Morningstar. He joins us now. Dave, very good to talk to you again. Thanks for joining us. So,
of course, good to see you, Andrew.
Midway through the year, Dave, so not a bad time to just reassess where we're at as far as equities are concerned. Let's start then with your view as to those valuations and I guess looking ahead to the third quarter.
Yeah, so right now the US market is trading at a 3% composite over our fair valuations for all of the stocks that we cover in the US. It's about 700 stocks. And we do take a slightly different tack than what you might hear from a lot of other strategists. Yeah, we do this bottoms up view where we take a composite of where the market's actually trading as compared to all of the stocks that we cover. A lot of other strategists do that top down where they come up with some sort of earnings estimate, they apply some sort of multiple to it, and then somehow goal seek what they want that market price target to be. So again, I think we're probably one of the few people out there that's really telling you the market's really starting to get to be stretched at this point. When we break the market down into the Morningstar style box, I'd note that value stocks are still undervalued, trading at about 9% discount to fair value. However, core stocks and growth stocks are both trading at pretty substantial premiums, about 7% and 6% respectively. So in our view, while I'd probably still be market weight equities, I don't think I'd underweight equities just yet. I would overweight the value category, underweight core, underweight growth. And then by capitalization, those large cap stocks, again, that's where all the AI stocks are, that's getting to be a bit overvalued at a 6% premium. So I probably have a slight overweight in the mid cap category, that's at a 6% discount, and a much larger overweight in those small caps that are at a 20% discount.
Dave, you mentioned the mega caps, and I guess questions still in regarding that very narrow leadership we have seen. A lot of that driven by AI, of course. Taking a look at those AI-related stocks, what's your view?
Well, first of all, I think what people don't realize when you look at second quarter returns here in the US, they actually would have been negative in the second quarter if you took out like the five, largest returning stocks, the Nvidia, the Apple, Amazon, Broadcom, and Microsoft. So again, you talk about it being a very concentrated market, and that it is. So, the question I'm just getting over and over right now is the AI trade over? So first, I do have to say in the short term, just because a stock is already fully valued or already overvalued, doesn't mean that it can't become more overvalued in the short term. But according to our valuations, I think the huge gains and the outperformance in the AI stocks that we've seen over the past year and a half is probably behind us. So we did run an attribution analysis, and since the end of 2022, just 7 stocks are equivalent to 56% of the market return. And when I look at our ratings, they've just run their course. And just looking at the list here, Meta Platforms was a 5-star rated stock at the end of 2022. 5 stars being our highest rating, meaning that we think it's significantly undervalued. That's run up so much, it's now a 2-star stock, meaning that we think it's overvalued. Amazon, Alphabet were both 5-star stocks. Those are now 3-star rated. Nvidia, Microsoft, Broadcom, also 4-star stocks that are now 3-star rated. And I'd caution Nvidia, that's still actually getting to be at the top of that 3-star range. So if that one were to move up much higher, that actually could trip into 2-star category as well. And then lastly, Apple, we thought that was pretty fairly valued, coming into this, thematic time frame. It's now moved up, and especially just over the past couple of weeks, really since the developers conference, that it's now a 2-star rated stock, meaning we think that one's, run too far to the upside.
What is your view on Tesla? We just had that news out, just as far as its vehicle delivery is concerned, not falling as far as perhaps suggested, but obviously facing intense competition, particularly from China.
Yeah, so Tesla is currently a 3-star rated stock, meaning that we think it trades within the fair value range. And of course, Tesla is just a highly volatile stock. Tesla isn't necessarily the value of the number of the cars they produce this year or even next year, but really where you think that company is going over the next 5 to 10 years. So we do have a positive view on the company. We are looking for electric vehicles, specifically battery electric vehicles, over the course of the next decade to be anywhere from 60 to 66% of total global new auto production. So we're looking for a lot of upside over the long term, but the stock pretty fairly valued at this point.
Dave, let's take a look then at a sector basis and looking at where you're seeing opportunity right now then. What stands out to you?
Well, it's still that real estate sector, and real estate probably is going to be undervalued, for a while, just based on what's going on in the fundamentals there. But the sector overall does trade at an 11% discount to our fair values. Personally, I'd still steer clear of urban office space. I think there's just greater risk to the downside than upside opportunities there. But we really find a lot of value in the real estate with defensive characteristics. A lot of these names have been pulled down with the overall sector, and we think they've just been pulled down too far. So as far as defensive characteristics, specifically, we like the healthcare facilities, things like, medical offices, research facilities, life science buildings, and so forth. So we see a lot of value there. Ventas and Healthpeak are our 2 picks, both 5-star rated stocks, trading at about 30% discounts. And then the other sector I really want to highlight is going to be energy. That's trading at a 7% discount. I think investors should be overweight that right now. And one of the characteristics that I really like about this sector, we actually have a pretty bearish view on the long-term outlook for oil and oil prices. So we're looking for West Texas Intermediate, over the mid-cycle to fall to 55 a barrel. Of course, it's over 80 right now. And I think that, if oil prices were to stay here or move higher, there's a lot of upside leverage in these names. Worst case scenario, if we're right and oil goes down, a lot of these names are still undervalued, even when we plug that into our models. So among the global majors would be Exxon. It's a 4-star rated stock at a 17% discount. Among the US producers, I'd highlight Devon, also a 4-star stock at a 17% discount. And lastly, with energy, I think it just also provides just a good hedge in your portfolio, against any kind of geopolitical risk or if inflation were to stay higher for longer.
Dave, just returning, I guess, to that AI thematic, and a lot of talk, of course, the amount of energy that is going to be required, particularly as far as powering those data centers are concerned. So that feeds further into, I guess, your view on energy. Whereas utilities, have you missed out then if you wanted to play that? Because I see that you're rating utilities as pretty much as fully valued to overvalued at this point.
Yeah, that's an interesting sector. So utilities got absolutely hammered last fall when interest rates were really starting to rise, in the United States. Our utilities team, really just came out. They were pounding the table just as far as how far undervalued they thought utilities were last October. They thought the fundamental outlook for the sector was as good as they've ever seen it, but yet multiples, were very low. Utility sectors had quite a rally since last October. Again, I'm seeing a lot of stories coming out talking about, how there's going to be a huge demand for electricity. AI computing, of course, just requires multiple times more electricity than traditional computing. But at this point, if you're buying into utilities and just trying to play that theme, I think you're already 8 months, too late to the trade. Now, having said that, there are still some individual stocks that we think do have, some good upside appreciation potential. The one I'd highlight here is WEC. It's the old Wisconsin Electric. Of course, Wisconsin being one of the more northern states, so it's going to be in a colder region here in the U.S. So that'll make it a lot easier, for them to keep it cool, as far as the air conditioning bills that they'll need there. That's a 4-star rated stock at a 20% discount, provides a 4.3% dividend yield.
And Dave, just to round it out, we take a look at the Australian market, heavily weighted in terms of materials. How do you view the basic materials sector at the moment, given a lot of those commodity prices have come off?
I think with basic materials, overall it is undervalued, so it's a good area to overweight in your portfolio. It's trading at a 5% discount, but I think you also need to be a little bit more idiosyncratic. I think it's a little bit more of a stock picker's sector. So the two areas that I would highlight is going to be the gold miners. We think that those are undervalued, even though we do have a long-term bearish view on the price of gold in and of itself. So we're looking at gold falling, all the way down to 1,780 in US dollars by 2028. But if gold prices stay as high as they are or move higher, again, a lot of upside leverage, similar to the energy sector. So our pick there is going to be Newmont Mining. That's a 4-star rated stock at a 20% discount. And then the other one is going to be the crop chemical producers. It's a little bit of a story. What happened there was that in 2021 and 2022, the ag industry just over-ordered because of all the shipping bottlenecks and the constraints that we saw in that market. And then, of course, in 2023, as those constraints freed up, they ended up using up a lot of the excess inventories that they had. So we saw reduced sales. And of course, the market sold off on that. But now that the supply and demand dynamics are normalizing, we're seeing a lot of opportunity there. That pick there is going to be FMC, trades at only half of our fair value. And while you wait for that stock to work, it pays a 4.1% dividend yield.
Dave, terrific to get your outlook there from Morningstar. Thanks so much for joining us.
Thank you.
Quick check of where we're likely to be going when we get underway in just a minute or two. And we are looking to break that recent downward trend on the ASX with the futures up by about 0.25%. Stay with us, the open is just around the corner.